Welcome to the Opportunity Zones podcast. I'm Jimmy Atkinson. GTIS Partners is one of the largest Opportunity Zone investment firms in the country. They are currently developing 17 Opportunity Zone real estate assets and have raised $850 million of equity across two OZ funds. They're building close to 4,000 residential units plus 2.5 million square feet of industrial. Joining me on the show today is Head of Capital Markets at GTIS Partners, Peter Ciganik, and he joins me today from New York City. Peter, welcome back to the show. It's great to see you. How you doing?
Hi, Jimmy. Thanks for having me again. Always good to see you and happy to chat about opportunity zones and the new program.
Awesome. Well, it's my favorite topic to discuss, at least on this show. We love opportunity zones here, so let's get right into it. We're going to talk about the new program, the OZ2 program, in a little more detail later. But first, I just want to get from you, Peter, a sense, what's the current state of capital markets and capital flows into opportunity zone funds as we sit here recording this in August of 2025? We're a few weeks removed from President Trump signing the One Big Beautiful Bill Act into law and making opportunity zones permanent. But what's been the state of capital flows lately? We just had some data released from Novogradac a few weeks back that shows a little bit of an uptick in equity raising across qualified opportunity funds in Q2 of this year, north of $1 billion raised according to their survey participants. But what have you seen on your end recently?
We have seen the same, a little bit of an uptick, and I think it's basically just generated interest in opportunity zones and a little bit of revival because there's been a lot of stuff lately in the capital markets and the economy in general that maybe distracted the attention of investors. But with opportunity zones being such a prominent part of the Big Beautiful Bill, they had another look and remembered there is this program that was started a few years ago, but is still delivering great tax benefits. So even though we're still in the first iteration of the program and the second one really won't start until 2027, as we all know, there's been a little bit of revival of interest, and we've seen a pickup in fundraising just because it broke through the noise.
That's kind of interesting because in theory, what I've been telling people and what I've been hearing from other professionals in the space, Peter, is that making the program permanent is great, provides more support and infrastructure in the program long term. But the fact remains that the actual tax advantages of the current program that investors are able to access through the end of next year, through the end of 2026, are diminishing as each day goes by. And really, we're going to get all of those enhancements from Opportunity Zones 2.0 won't kick in until January 1, 2027. But you're saying just the fact that opportunity zones, there seems to be a lot of momentum, they're in the news more, you've actually seen a little uptick in interest. Do you imagine that, what do you think 2026 will look like? And then what do you think 2027 is going to look like for you?
People are talking about a gap in 2026, and I think that might be the case just because at some point investors will be considering the new benefits and postponing the sale decision and the gains to 2027 to take advantage of the more interesting benefits. But there are some, what I call, forced gains in the market. Investors who receive mutual fund gain distributions, business owners who sell a business, real estate transactions are not going to stop just because of opportunity zones. And sometimes it's an afterthought when you realize a pretty nice gain and all of a sudden you are facing a pretty large tax bill and you talk to your financial advisor, are there any ways to moderate that or efficiently deal with the tax impact of a transaction? And opportunity zones should be in every advisor's toolkit, but I think they kind of a little bit forgot in the market volatility that we've seen over the last couple of years that this tool existed. I think the Big Beautiful Bill brought it up again in the news cycle and in the attention span, and we're seeing pretty good market conditions in terms of gains. Equity capital markets, the public market is really kind of at a record again. In some private transactions percolating as well. So I think it's a combination. The attention was focused on it because of the bill, and the capital markets gains out there are pressing the issue of dealing with the tax efficiently. That's why I think we're seeing an uptick. We'll see what 2026 brings. I think it might be a bit of a gap there.
Yeah, there might be a bit of a gap there. I think you're absolutely right though. Stock market is at new highs currently as we're recording this in mid-August of 2025. And I like to talk big picture conceptually. If you have a lot of unrealized capital gains in the stock market, maybe you are sitting on some low cost basis, highly appreciated stock market assets. Maybe you're a little bit overweight in stock. Maybe it's time to rebalance your portfolio. If you trigger that gain, whether it's now or next year, maybe you don't want to wait until 27 to rebalance, and maybe you just need to get something done now. And then I also forget sometimes, Peter, that not everybody on the planet knows about opportunity zones, even nearly as well as someone like you or I might. Maybe they're not aware of the program at all, and then they trigger a gain yesterday or today or tomorrow or next week, and they only start hearing about the program that way. So yeah, we can't always allow the tax benefit tail to wag the investment dog. Sometimes you just trigger a gain. When you trigger a gain, you find out about opportunity zones after the fact, and then you go ahead and take the plunge. So what type of investors are you seeing in your experience, Peter, are the most active right now? Or are we talking about larger institutional players? Are we talking about family offices? Or are we talking about more individual high net worth investors?
It's all of the above for us, as we have partnerships both with large RIA networks, and we work with family offices in our institutional investment business that is not related to opportunity zones. But when they do have a taxable gain, it's something on their mind. I would say that group, the family offices, did not forget about opportunity zones. And so I wouldn't say there's a huge revival of interest there. They've had it on their mind, but to the extent they're seeing larger gains, I think it's being utilized a little bit more now. We do still find financial advisors, RIAs, who are either largely unaware of the program or have kind of forgotten and put it in a back drawer because it was a 2018, 2019 phenomenon, and they have not since then really had a need for it. But as capital markets generate gains, they're um, refreshing their knowledge of it, and we find quite a lot of education is still needed 6 years later. People discovering or rediscovering the program as a toolkit for tax efficient investing.
One other thing that everything you said is correct, I think. But I also think, Peter, that what is happening is that a lot of financial advisors, RIAs, even accountants, attorneys, anybody advising capital sources, high net worths or family offices, multifamily offices in some cases, a lot of those professionals could, especially after, 2018, 2019, 2020, could afford to ignore opportunity zones. Just knowing in the back of their minds, oh, this thing is going away after 26. I've already missed some of the bigger benefits. I'm not going to bother spending any more of my time or my team's time and resources studying this and figuring out a good investment platform for my clients. Well, now that the program's been made permanent, if you're an RIA or a multifamily office, I don't think you can afford to ignore this going forward, right?
I think that's right. And let's make that the third reason why we're seeing a pickup. The gains in the market, the fact that the big, beautiful bill brought it up to everyone's attention. And then I think you're right. The third reason is that devoting the time to study a new program when you have so many things as a financial advisor may not have been worth it until this became permanent. And what I like to say about the new program is really uh, permanent and supercharged Roth IRA for real estate. That's how I think about it. It's tax deferred growth, effectively tax free at the end. That's how Roth IRAs work. And you only need to keep it for 10 years, not until you retire. So that makes it supercharged. It's also a lot easier than doing a SEP IRA or something that would allow you to do private real estate. Those are fairly complicated. It's so much easier to think of this particular program as your Roth IRA for private real estate assets. And when I say that with financial advisors, their attention picks up because that's what they work with, planning long-term, Roth IRAs, 401ks. Now should we see private assets in 401ks? That will be a whole new universe. We'll see how that goes.
Yeah, that will be interesting. But yeah, I love the term supercharged Roth IRA or super Roth IRA. I also use that term from time to time. It seems to resonate with a lot of investors and advisors. We mentioned, or you mentioned a moment ago, that opportunity zones were kind of a phenomenon in 2018 and 2019. And certainly there was a lot of funding that took place for opportunity zone projects during that time period. A couple of reasons. One, the program was new, so there was this excitement level for it. Two, the benefits were fantastic. Then it was a 6 or 7 year deferral period that you got, 6, 7, or 8 year deferral period across those years, and those basis step ups at the 5 and 7 year marks were still available. So the tax incentive was better, but also the interest rate environment, the general macroeconomic environment was much more favorable for doing real estate transaction and development deals back during those early days. But fast forward to, through COVID and now our higher interest rate environment, I think we're seeing some semi-distressed or distressed assets that were originally meant to be developed as opportunity zone projects falling into a little bit of trouble. Are you seeing that at all? And what are you guys doing to capitalize on that, if anything?
We are, and it's not specific to opportunity zones, but the tax structure may complicate things even further with those assets. And the issue really is twofold. One, there are development projects that were not fully funded when they broke ground. That's kind of a mistake from a developer perspective to do that, but with every bullish cycle, it does happen, and people break ground on a project without having the full capital stack. With cost overruns and delays, there are projects out there now that are essentially short of capital to complete. And that's an opportunity for fund managers with dry powder to step in. Again, not specific to opportunity zones. We see that in other areas as well. But with opportunity zones, even more so because it's become a question of who do you get the capital from? Your existing investors, in which case, if you call new capital, you would reset their 10-year clock, or do you admit new partners into a project? And that would generate a conflict on exit because who should get the benefit of an upside? The investors who supported you originally with their risk capital, or the ones who came in 4 or 5 years later to rescue the project, so to say, right? So not an easy equation there. And we've looked at a handful of projects that are struggling with these issues. We had one semi-distressed transaction, which the asset was actually really good, but just had a capital issue of this sort. The other problem that people are having generally, not just with up zones, is that a lot of projects were financed with very low cost capital, senior or construction mezzanine loans, 3, 4 years ago at 3.5% interest rate. Those loans are coming due. If they were short-term loans, 3 years or 5 years, they need to be refinanced, and interest rates are at 7. Meanwhile, leverage that's available has actually been reduced. You could have probably gotten a 70, 75% LTV loan a few years ago when capital was plentiful and cheap. Today, if you want to finance a development, you'll find it harder. It's better than it was a year or so ago, but it's still expensive and the leverage is lower. So you'll have a capital gap. If you go from 75% to 60% LTV, you have a gap. And developers are having to raise this capital in between, either as a preferred equity or a mezzanine loan. With opportunity zones, the problem becomes compounded in that you can't really take in or invest in it in the form of credit. You have to do a preferred equity if you recap a project like that. And we've looked at those, and we're hopefully going to close on a transaction like that in the near future, which is taking advantage of a capital distress while the asset itself is actually a good asset. That's a common theme across most property types. The third type of distress is truly fundamental asset distress, and that is at this point largely limited to office properties. There are some opportunity zone office projects that I know are struggling, but the whole sector has kind of become a little bit of a nuclear waste in some ways. There are only a couple of markets where office is going strong, and I think those projects will have trouble recapitalizing because of fundamental distress. When your top line disappears with work from home and just a different approach to office use, it's very hard to reconfigure it through a capital transaction versus an apartment project that's fundamentally good. It just is a little bit over leveraged or needs more capital to get through leasing. In the office sector, it's kind of what happened to retail 20 years ago when Amazon took their lunch. This time it happened to office.
Yeah, great breakdown there, Peter. Great insights on those different types of distress. Let's shift gears. I want to talk about OZ 2.0, the one big beautiful bill act, and the permanence of opportunity zones. I'm sure you and your team were tracking this legislation's progression through the House and the Senate throughout the spring and early weeks of summer. And then finally, it hit the president's desk on the 4th of July, just a few weeks ago, and was signed into law. And now we're in this brand new world where opportunity zones are no longer some temporary tax incentive. They're a permanent part of the tax code. And we've got OZ 2.0 enhancements taking full effect on January 1, 2027. What's your overall perspective of the new program, Peter?
I was actually quite positively surprised by the final product here. And I'm going to speak a little bit out of both corners of my mouth. I would have loved for the first program to be extended and kind of provide some kind of a bridge for the capital part of it. But I actually kind of understand why they wanted to make a clean break there, because we're really moving from a 10-year trial program into a permanent program that will be there forever. And again, will kind of become like the Roth IRA for real estate. So I actually understand why they did that. And I think they cleaned up most of what needed to be cleaned up. There are a few small items that Treasury will probably, hopefully, address in their guidance. The fact that there is this gap year in 2026 is not ideal, but I'm not sure that there was a better solution out there to that question. So overall, I think I'm positive on it. The fact that it's rolling, that the deferrals are 5 years, you don't have this cliff at the end of 5 or 7 years, which is creating a lot of questions these days. People still asking, am I supposed to pay the tax for 2026? The answer is yes. Remember that. Very important. The fact that it will be rolling and that the 10% discount is there forever, that's very positive. It is quite attractive to have that upfront reduction of your original gain amount. I think that motivated a lot of people. Obviously, at the end of 2021, when that was expiring, we took in hundreds of millions, and other managers took in a lot of capital. That was the highest amount raised in that quarter, and that just signifies that, you know, a bit of a guarantee of reduced taxes up front will motivate people.
Yeah, absolutely. I think the program will certainly experience a resurgence in interest. It already has, but I think it's going to pop even more starting in 2027. Yeah, the legislation didn't give us everything we wanted, but on the whole, it's really good piece of legislation. Really great news for the opportunity zones industry, for opportunity zone investors, for developers and communities all over the country. Part of what the new legislation does is it tightened up the definition of low income census tract or low income communities, such that there's going to be stricter criteria to qualify as an opportunity zone location starting when the new designations take place, when the new map hits in 2027. They decreased the median family income ratio from 80% of the broader area or state down to 70%. They also eliminated non-low income contiguous tracts from being able to qualify. Have you studied this at GTIS Partners, and what impact will that have on your projects going forward?
We have. That's the first question that the investment team has, because they have to put the money to work and they want to know if their markets and preferred locations will qualify. Obviously, we don't know the final selection. That will not be available until probably the end of next year. But immediately as this criteria came out, we went back to our mapping software to figure out, where do we fall? Where are our projects? Would they qualify? And I would say that the reduction from 80 to 70% of AMI is only the third most impactful reason why some projects would not qualify anymore. The first one, interestingly, at least in our portfolio, is the fact that communities have improved dramatically over the really 15 years since they were designated with 2010 data. We looked at our entire portfolio, and about three-quarters of it would still potentially qualify. Obviously, we don't know where the zones are, but under the 70% definition, three-quarters of it would still be in places that are qualifiable. The reasons why the other quarter fell out were either they were contiguous zones, so will not be there for sure, or interestingly, the communities have grown so much that they fell out not only out of the 70% bucket, but the 80% bucket. And I think that is actually what the program was supposed to deliver in terms of improving communities, improving income, reviving places that were in need of investment. And I think it speaks to the success of the program that we've had several locations fall out because they've improved so much they can't justify the qualification.
Yeah, that's really interesting, and I think that speaks to the investability of those OZ 1.0 tracts for the rest of this year and also in 2026. Once 2027 and 2028 hits, I think it's going to become harder and harder to be able to deploy capital into those OZ 1.0 zones. First of all, we're not exactly sure what that's going to look like and what's going to be allowable through 28. But also, it's just harder to, if you, especially if it's a ground up development deal, can you even start a project in 27 and have it wrapped up by 28? I don't really know. All of this is to say, I think it's a great reason to invest sooner rather than later for a lot of investors and advisors who might be thinking, why don't I just wait until 27? The OZ 1.0 zones are very attractive on an investor level in many cases because of the fact that the data is old, and a lot of these areas have already really improved quite a bit and really are quite investable and they won't be eligible under certainly not the 70% bucket, but maybe not even the 80% bucket as well. What are your thoughts on that line of thinking there?
Well, that's for sure. There's the contiguous zones. There's the fact that these locations have improved pretty dramatically over the last 10 years. And there's also the fact that at this point, you kind of know where the best zones are from the 1.0 designations. I think we've spoken about some of our projects in the past, but we have uh, developed office and industrial and residential properties. One of them we've sold to Google in Boulder, Colorado. That's a kind of opportunity zone that really won't be available in the new iteration. We have projects in downtown Brooklyn, which pretty much all of it was designated under the old program. Quite amazing because most of it is contiguous zones, to be frank, and are going to go away. But Brooklyn today is the place to be. 10, 15 years ago, you would live there to commute to downtown Manhattan for a job. Now people actually want to live and work in Brooklyn. So it's the place to be. In Phoenix, we have a community that was a piece of desert when we started. Today, it's a thriving new town of 5,000 homes. Some of them sell for $6, $7, $800,000. Clearly not a distressed place by any means, but that's because the capital was invested to improve it over a decade, right? Um, so to go back to your question, for sure there are some OZ10 tracks that are attractive, have become more so over the past decade, and unfortunately won't be available. But there will be new ones, and this improvement cycle will happen again with the new zones. As soon as you put in some capital, it kind of builds on itself. Because as investors, we want to know how much did people pay for a piece of land, how much did it cost them to build it, and most importantly, what are they renting for? If we have proof that someone built something and rented it for a certain amount of dollars, that goes into our underwriting with a smaller contingency number, meaning less risk, because we know somebody else built it and rented it. That makes it actually easier to invest for us because it reduces the risk, just knowing that capital has already been invested in some of these places. So it'll build on itself. It will be very interesting and important to see how governors think about these places. And I'm kind of hoping that they will redesignate as many of the old zones as possible under the new qualifications.
Yeah,
In
it's
some
interesting.
states who didn't do a great job, I should add to a footnote there, some states didn't pay attention to this program. It was an afterthought, clearly. I'm hoping that they will realize they missed a train there and that they missed an opportunity to gather capital, and they will do a better job designating them this time.
Oh, you're absolutely right. Some states it was an afterthought, and actually to cut them some slack. I don't know if I'd pin it so much on the states, but the entire process was just much more rushed last time. First of all, nobody knew what opportunity zones were, and then suddenly they're law in late December 2017, and the determination period for governors to start selecting and nominating census tracts began on that day when the Tax Cuts and Jobs Act was signed into law at the end of 2017, right before Christmas and the New Year's, and then everybody
Yeah,
comes back in January, and all of a sudden, well, now we only have however many days it was to nominate. It was a very rushed process that took place over those winter and spring months, and it was finished by early July of 2018. This time around, first of all, this program's been in existence now for 7 years. Everybody knows, at least, everybody at the state level in an economic development office is at least somewhat aware, hopefully, of what the opportunity zones tax incentive is. And the determination period for nominating new OZ 2.0 tracts to the U.S. Department of Treasury doesn't even begin for almost another one full year. That process will start in July of 2026. So I think this will be studied a lot more closely by every state around the country, by all the overseas territories, by Washington, D.C. gets to nominate a certain number of census tracts as well. I think this process will be much more thoughtful than it was the first time around. And I think you're probably right, Pierre. I would expect that existing zones that are still eligible, particularly if there's capital flowing into them and capital flowing into current projects there, I think there's no reason why they shouldn't get redesignated going forward. But all that will play out over the next 12 to 15 months here, and we'll find out soon enough. Little bit toward the end of next year is when it'll be.
yeah, yeah. And obviously there is the rural incentive that's
That's
new and
right.
will be interesting to watch. We do a lot of industrial investment, and just looking at the definition, it seems that a lot of our industrial properties could fall into these regions because they typically are located along the highways at major intersections outside of the municipalities. I think that will be a sector that will really potentially benefit from the rural incentive. The residential property type, probably less so. Those are really concentrated in the CBDs and will likely only, if at all, qualify for the regular benefit.
Yeah, the types of residential buildings that your firm is developing, we're talking several hundred unit mid-rise, maybe high-rise buildings in some cases. Yeah, those don't do so well in rural areas, but the industrial buildings certainly should shine under that new program. If you were to launch a qualified rural opportunity fund that funded some industrial projects, I think that would get quite a bit of traction. Well, let's. I think that's a perfect opportunity to segue a little bit more into talking about what is your strategy. What markets do you like? You mentioned Boulder. You mentioned Brooklyn. You mentioned Phoenix. I think it was. Which geographies is GTIS really leaning into for opportunity zone development going forward? And what do you think the breakdown is going to be starting in 2027 and beyond, especially considering that rural component that you just mentioned, Peter, of how many multifamily buildings are you going to be developing versus are you going to focus more on that industrial rural piece a little bit more maybe?
We might, just because of that incentive, we will certainly be incentivized to look. We won't invest just because of it. Projects need to pencil on their own and have an attractive return, but it will definitely motivate us to look for that.
And just to interrupt you there, in
Yeah,
case anybody's unclear what that benefit is, if you haven't been following opportunity zones very closely, an investor who defers an eligible gain into a qualified opportunity fund starting in 2027 and beyond, we're talking about OZ 2.0 benefits now, you'll get a 5-year deferral period. And then on that deferral date, when you recognize your deferred gain, you'll get to reduce it by 10%, unless it's a rural project. If you're investing in a rural opportunity zone deal, that reduction of your initial gain hits 30%. So instead of paying $1 million in paying based on $1 million gain, you get to pay on a $900,000 gain, typically with an ordinary non-rural deal. If it's rural, you pay based on a $700,000 gain. Is that right, Peter?
That's right. And this is one of the points where I really think they should have done it a little bit differently and not tie that 30% rural benefit to a QOF, but rather to a QOZB and allow that additional incentive to be applied pro rata based on projects that you have in rural zones rather than funds. To have an entire fund devoted to rural projects will be a high hurdle. And from an investability perspective, I think investors will be skeptical at first whether that can be a strategy that stands on its own legs. Whereas if basically the program allowed a pro rata 30% reduction if you did a couple of rural projects within a larger fund and you would apply 20% of the 30% incentive, I think you would see a lot more of those. That is an unfortunate definition in the legislation. I don't think that can be changed through Treasury rules. That's written as it is. We'll see if we can muster enough projects to create a whole rural opportunity zone fund. On the property types, speaking of those that could be interesting for rural locations, um, we do not do data centers, but a lot of them may end up being in rural zones. And that's an interesting property type that I haven't seen heavily invested through QOF capital. Industrial, which we do a lot, and I think will benefit greatly. And then other non-real estate type assets, which surprisingly haven't really garnered a lot of investment, whether that's oil exploration, timberlands, agricultural investments. Remember, as you know, it's not just real estate or real assets. You could even have operating companies in these locations, and certainly agriculture is tied to rural places. So I think we'll see a new type of animal emerge from the new legislation. We probably won't be part of that because we like to stick to our knitting and expertise. It's still true that that's paramount, and having the skill set, the experience, and the track record matters more than a tax incentive. We'll extend it probably on the edges. So we might do things like industrial outdoor storage, which may be more rural. But our main focus is industrial and residential properties, anything you can live in. So that would include student housing, of which we've done 3 projects in OpZone so far. It would include senior housing, single family rentals. We have a couple single family rental communities. And on the industrial side, there are different subtypes with cold storage, outdoor storage, and so forth. I'm not sure if office will come back because of this incentive, but that will be a struggle that's really tied to the broader market shift there. And then there are other niche property types that might be getting a rural boost, but I would say probably residential will still be the focus of the market. For us, it's actually more half and half between residential and industrial. So we offer that diversification by property type. In terms of geographies, I think that was your other question. We're very active in the Sun Belt and will continue to do so. That's the area of growth in terms of jobs and income. And as a new development investor, which we are, not just for UpZones, but for our other funds as well, we have to go where there is growth. That's not to say there are no good investment opportunities in older, mature markets, but to invest in the Rust Belt today, you would have to find great value and more like a distressed approach where you can acquire assets at great value, maybe reposition. To do a new development, you really need growth. You need population coming to your market, you need new jobs, and you need a business-friendly environment. And that today exists mostly in the South, whether it's Texas, Arizona, Florida, Georgia, the Carolinas. That's where most of our investment is. And then coming up the eastern seaboard through the Carolinas, Virginia, Pennsylvania, and around New York, where we are based. It's not the easiest market and also not the fastest growing, but it's so large that there will always be opportunities here in our backyard that we can find. And good portion of our portfolio is located here. Interestingly, as New York has recovered strongly from the pandemic, last quarter was the first one, I believe, where office visits are above the 2019 levels. First data print there in terms of recovery. We've been able to tap into that recovery as well. I think the West Coast is a little behind. I'm particularly concerned about LA, where the growth drivers seem to be diminishing and they have policy issues as well.
Yeah, but office is coming back in New York City, maybe. It sounds like that's very interesting. And yeah, certainly a lot of other demographic tailwinds in that part of the country where you are focused on, particularly in the Sun Belt. Yeah, so we talked about you guys really have like a 50-50 split, it sounds like. I think I heard you say multifamily or residential versus industrial. I want to focus on that industrial part for just another minute or two before we wrap up today's episode, given that there's going to be a lot more interest in rural OZ investing, given these new enhancements to the opportunity zone tax incentive. Can you speak a little bit more about some of the subtypes you're developing? Is there any manufacturing? Is it all storage, cold storage, warehouse distribution, maybe logistics, or what exactly are you playing in? And are all of your industrial projects in rural areas, do you suspect, or maybe just a portion of them?
Most of them are. We
Okay.
looked at the map and they would technically or potentially qualify for rural zone incentives. We focus on a few subtypes within industrial. It's obviously a huge property type that can range from what's called smaller flex spaces that combine retail and storage to larger distribution warehouses to the million square foot bombers, as we call them, for e-commerce distribution that Amazon or UPS use. And then on the other end of the spectrum is manufacturing facilities, both from sort of light manufacturing and assembly all the way to heavy industrial usage. The third axis is it a box or is it actually outdoors, just an open area, which is called industrial outdoor storage? And then what's inside the warehouse also can be different. Cold storage is something that's outfitted with a lot of cold storage equipment, obviously freezers and so forth. And we've done a little bit of all of this except for heavy manufacturing and except for the sort of small bay type, mixed use kind of retail stuff. We're kind of in the middle. And that means we've done distribution, logistics facilities. We've leased warehouses to Amazon or smaller 3PLs, the third party logistics providers that work for retailers who do not have their own supply chain or do not manage their own warehousing. You have these 3PLs, those are often our tenants. And we've done light manufacturing in the battery belt around Charlotte, for instance, where a lot of EV factories are now being built. We have tenants who store or assemble batteries, electric batteries. That's considered light manufacturing use. They don't actually really make them there. They just assemble them and put them into the cars. We have a tenant that's a furniture maker. That's a manufacturing use. We have a tenant that is a paint company. They store and mix paint in their warehouse. So it's a little bit of a range, but we're in the middle between 200 and 1 million, 200,000 and 1 million square feet of size. And we do some cold storage in light manufacturing.
Fantastic. Well, Peter, we are just about out of time. I really appreciate you giving us some time today and appreciate your insights into all things opportunity zones and a little bit about the GTIS Partners strategy. If we have any investors out there who are interested in learning more about your platform, Peter, and learning more about you, where can they go to learn more?
Obviously, on our website, which is gtispartners.com, and there is a ticker tape up there with available strategies. We don't just do opportunity zones, we do other things, but there is one that's at the top for our GTIS Qualified Opportunity Zone Fund number 2, which will be open until the end of the year. At this point, it's at about $230 million of capital, and we're starting to invest it in what we believe is a great point in the cycle. Real estate is probably at the bottom of valuations right now, and with interest rate cuts hopefully coming soon, we should see valuations improve. We'd like to put that capital to work before that happens. So we invite investors who are interested in this and have gains to modify to look at our second fund. Thanks so much, Jimmy.
Perfect. Thank you, Peter. And for our audience out there today, if you enjoyed today's episode, hit that like button, give us a thumbs up. We're also going to have show notes available at opportunityzones.com/podcast. If you want to read more about today's show, we'll link to all the resources that we discussed with Peter today. And please be sure to subscribe to us on YouTube or your favorite podcast listening app to always get the latest episodes. Peter, again, thanks so much for joining me today. It's been a pleasure.
Thanks so much, Jimmy.